any other kind of loan, in a wholly unprecedented way.
In the past decades, it was always the case that the general population would default on everything else in order to keep their house at default. Credit cards, they default on their loan to buy their fridge, they default on their car loans. And then finally they would default on their mortgage. They're keeping their credit card current and they're defaulting on their mortgage first. This has never been seen before.
When the scale of losses from subprime loans could no longer be ignored, the holders of all those AAA investments made out of subprime loans had a horrible awakening. In August 2007, a big French bank, BNP Paribas, sparked a global financial panic when it announced that it couldn't value its holdings of investments created from subprime loans.
When BNP came out with that, this was a moment we're saying, it's time to go home. Children, the party's over now.
Banks became reluctant to lend to each other because they weren't sure which of them were holding the subprime poison and whether they would ever get their money back. The multi-trillion-dollar money markets that underpin the global economy seized up.
The speed at which it happened, the way in which financial institutions just withdrew from the market because they were worried, I think that was unprecedented. And it surprised politicians, it surprised regulators, and certainly surprised the banks. So once you're in that vicious circle, lack of confidence, bit of lack of trust, you don't know who's holding the problem, everybody then, like lemmings, run for cover.
Once people got scared, they started being less happy to lend to each other. They started being less happy to work with each other. And again, that in itself led to all sorts of other activities, specifically securities going down in price.
Was that fear rational?
Is fear ever rational? I don't know, but is that fear rational? I'll give you a short answer, yes. The fact that people did not know the full exposure to the subprime area or to the SIV area or whatever, yes, of course, if you don't know something, being fearful is rational.
Once the river of money stopped flowing, with banks and financial institutions loath to lend to each other, there was a very high-profile casualty in Britain.
One of Britain's biggest mortgage lenders needs emergency support from the Bank of England. Northern Rock has problems raising money because of the crisis in the financial markets.
Yeah, absolutely clear. There is no suggestion that this business is fundamentally bust, but merely running out of money in this way for a bank is extraordinarily serious.
The company was very successful because it was taking a tremendous amount of risk.
Northern Rock went to the brink of insolvency because its business was dependent on raising money by selling its mortgages to international investors. And when investors were burned by losses on subprime, they refused to buy any mortgages, Northern Rock's or anyone else's.
They were actually possessed of enough capital to survive approximately a 1-week shutdown in the capital markets. That was all.
Banks across the world, in Germany, France, Switzerland and the US, have lost tens of billions of dollars and have had to be bailed out by governments or by investors with deep pockets.
The Swiss bank UBS says it suffered much bigger losses than anticipated because of its exposure to the subprime mortgage market in the United States.
And today, Barclays said it had written off £1.6 billion of risky investments related to US mortgages.
The global credit crisis has deepened, with America's fifth largest investment bank asking for emergency funding. Bear Stearns, which has been hit by the US housing market slump, has been bailed out by another bank and the Federal Reserve.
Some of the bankers responsible for the financial losses are losing their jobs.
Bonuses of investment bankers are going to fall drastically now that you're discovering that a lot of the banks, investment banks, are taking billions of dollars worth of write-offs, and these people are getting kicked out unceremoniously out of their jobs.
As for those companies bought by private equity, well, if they took on too much debt, they'll experience difficulties, which would be bad news for their investors and employees.
There are some clear examples of loans which are looking dreadful now. Some of the leveraged buyouts done at Fatface, the retailer, Countrywide, the estate agent. The loans on those companies are being dealt with regularly now at discounts of a quarter or more to their face value. So clearly there are some bad loans out there.
But many of the super rich who helped create this unsustainable boom are sitting pretty.
There are a lot of people who have made enormous amounts of money, created great mayhem, and I'm afraid they're not going to get hurt greatly by what's happening now. There is, I understand at the moment, for example, quite a shortage of high-end hotel rooms in the Caribbean, Mauritius and similar places, because these people have got nothing to do at the moment and lots of money.
Having trousered so much, the super rich apparently have a problem many of us would love.
Very top-end people are very liquid, have made a lot of money in the last 10 years. In fact, probably find it quite difficult to spend the money they've earned. And that's why companies like us, I think, are very successful, because we help them spend their money. Frankly, for companies that are producing such limited quantities of these very exclusive products, they can't manufacture them quickly enough. There's a new Rolls-Royce, the drop-head coupe, that was launched last year. If you were to walk into your Rolls-Royce dealer today, if you were lucky, you would maybe get one in 2 years. They continue to indulge in their passions, and I don't see that changing anytime soon.
And demand for the most expensive motoring experience on Earth doesn't seem to have evaporated.
The car is not only the most expensive and fastest car on the planet, but it's also one of the most usable cars. The customer who pays 1.1 million euros plus tax gets a car which is really second to none. The British have been the best European market, and they still are the best European market. They are only the second to the US. Our best dealership in the world, a single dealership in the world, is Jack Barclay in London.
So for the super luxe industry, price cutting isn't on the agenda.
The $1 million watch cannot be affected by no price. That's the extreme. The extreme is safe. At the 1 billion, there will always be demand for $1 million watch. That is for sure. And if you want to build a new watch brand and you want to go safe, start with 1 million, your first price. Then you are safe.
The reason the super rich can feel safe is that the gambles they've taken with other people's money have been so huge that the authorities have